Hey, Cameron Budzius here at the Mortgage Crew. So a big topic of discussion is the recent Fed hike and how that affects our housing market, our mortgage rate market. So as we all know, the Fed has hiked their rate by 0.75% in their last meeting. So this is the third hike of the year, and they project that they're going to increase that rate by another 1.75% over the next 4 meetings throughout the rest of this year. So what we need to remember here is that the Fed funds rate is the overnight borrowing rate for banks, and it's not the same as mortgage rates, okay? So it's more of a commercial number, not this residential mortgage rate number, okay? So a lot of people are wondering, well, how does this move in the Fed funds rate affect mortgage rates? So mortgage rates, they're primarily driven by inflation. Inflation is at a 41-year high right now, okay? So when the Fed hikes their rates, on the Fed fund rate, they're trying to slow the economy. They're trying to curb inflation. So they're fighting that inflation that's at this all-time, this 41-year high, okay? So as they hike their rates, they want to push inflation down. As inflation comes down, mortgage rates generally decline. Mortgage rates should decline as inflation declines, as inflation comes down, okay? So history proves this over the past 50 years with different rate hikes cycles by the Fed. We see that as those rates are hiked, inflation slows, mortgage rates come down, okay? So that's what we're expecting going into the coming months, coming years, okay? So any questions on this? I hope this clears up the difference between the Fed funds rate and mortgage rates, okay? They play off of each other, but they are two totally separate things. Any questions on this? Anything we need to talk about, time frames for your purchase on a house or anything similar, feel free to reach out. Cameron Budzius, the Mortgage Crew, 504-919-9504. Talk to you soon. Thanks.